Welcome, everybody, back to Tee It Up with Phil. I'm Phil Melton, your host here with Bellwether Enterprise. Uh, I am joined today with Chris Herrmann, who's Senior Vice President with Enterprise Community Investment, who oversees the conventional equity entity for ECI. So, Chris, welcome. Thank you so much for joining us. Appreciate it very much.
Of course, Phil. Thanks for inviting me.
Yeah. So, Chris, why don't we just start off with conventional equity? I know has a kind of a broad spectrum. It's not just
Sure.
one specific thing. So, can you kind of give an overview of kind of what all that entails?
Yeah, sure. It's conventional equity is essentially a division within enterprise community investment that we started back in 2013. So about 7 years in operation now to fill what we found was a gap in the capital markets for joint venture equity or conventional equity capital that's focused on affordable housing and has both a financial intent but also a social mission intent. And so we've been operating a series of funds that we refer to as the conventional equity funds dating back to 2013, but we're also looking to build the business out further into a larger investment management platform. And so we've launched a new fund as of about a year and a half ago called the Housing for Health Fund, which is a regionally focused investment fund in the Bay Area. And we're looking to take that experience and develop it into other thematic or regional funds around the country. So we really look at this as a platform within enterprise that can raise capital from institutional investors, from individual investors, from corporates, and invest it in a socially responsible way in housing. And the biggest series of funds, the one you're most familiar with, and we've done the most work together through, is the preservation funds, which we're on our fourth fund now.
Terrific. So, given the fact you've got such a broad spectrum now that you're in and you're trying to work to as you continue to expand, kind of what are some of the sweet spots that you look for in terms of your investments and your criteria, location, affordability? What
Sure.
are sort of the sweet benchmarks there?
Yeah, and sort of historically, we've really focused in three different types of apartment communities. Those being year 10 or later tax credit properties, Section 8, project-based Section 8 communities, and also what we refer to as market affordable, or might otherwise be referred to as workforce housing communities, where there's not an underlying use restriction, but they're still very affordable and they serve a very similar tenant profile. So we've historically invested along all three of those pillars. Um, Lately, we have in the last couple of years been doing an increasing amount of workforce housing. I think now with all of sort of the COVID-19 developments, we're sort of pivoting a bit, trying to find safe investments where we feel we can find secure returns right now. And interestingly, and not surprisingly, that's some often cases project-based Section 8 communities are very affordable properties. It seems that some of the transactions that we have been looking at in recent months might not be as attractive as they once were. The moderate value add opportunities where you're really looking for a lift, albeit a modest one in revenue. Those are a bit harder to justify right now because of all the uncertainties about what the market will look like, what the economy will look like. So those are all considerations. We're really just reigniting our pipeline. We entered March with nothing secured, ready to close.
Wow.
So we've sort of been sitting a bit on the sidelines, taking a break, seeing what develops, and now we're sort of pivoting to new business and finding some opportunities we think are attractive to move forward this year.
So, talk about your duration. I mean, I think that in the past I've seen durations have been kind of that 5 to 7 year.
Sure.
Given what's going on, and I'm guessing with cap rates being where they are, yields are getting harder and harder, and value add getting a little tougher. Is your duration starting to change a little bit in terms of your perspective for the investment horizon?
I think we typically will invest for anywhere from a minimum of a year hold period to 10 years. So that's kind of the spectrum that we work with. Typically, when we're investing for a year, 2 years, or maybe a little longer, we're bridging to something. We're bridging to a new tax credit recapitalization, or we're bridging to some kind of refinanced buyout of our interest. The longer term holds are the ones where the sort of disposition is a little less certain, where we're really relying on kind of what the then market cap rates are and the net operating income. So I think it's safe to say we've been looking at longer holds. We've stretched our fund lives out from when we started. They were 8 years, now they're 10 years. That has helped with some 10-year challenges for acquisition credits, as an example. But it's also helped with just kind of, what we forecast the NOI trend to be and cap rates to be over the next decade. It gives us a little more running room to exit when we think it's timely. We might underwrite a 10-year hold and end up exiting after 4, but having the opportunity to look at a long-term position, I think helps when we're considering new investments and trying to figure out how to fit it in our box, if you will.
So you mentioned that you didn't have anything in March at all. It kind of gotten kind of a dearth of opportunities are sitting out here just starting to open back up. I mean, so we're going to dive in. Obviously, when we put our business plan together at the beginning of the year, we can plan for a lot of things. I don't think a pandemic was anything that
Right.
any of us thought was going to be possible. So tell, as an investor, how is that, kind of impact? I know you mentioned you're focusing a little bit differently in terms of potentially a product type that might work, Section 8 or affordable housing. But, as an investor, how are you looking at this kind of disruption in the market, either from a potential acquisition strategy, from opportunities you think might come available?
Mhm.
How has this kind of impacted you?
Yeah, I would say all of the above, right? First, on sort of things that have immediately presented itself, because what we saw in late March, April, and May has, for the most part, been transactions that were in the queue that got busted for one reason or another. Another equity partner dropped out, or leverage conditions changed, right? As you know, the leverage environment has shifted, some for the better, some for the more challenging. So for the most part, we've seen a bunch of transactions that were in the works in January, February, and early March, and are trying to figure out how to move forward. And those have been challenging because, frankly, they feel like they're priced at yesterday's valuations, and we're optimistic that there will be richer opportunities to come. And the reality is, we don't have an unlimited amount of capital to invest, right? We entered COVID with about $100 million of discretionary capital in our preservation funds to deploy. And frankly, an uncertain environment of how our future capital raising efforts are going to play out. So we sort of had to balance, how much do we want to sort of make available now versus in 3, 4 months when maybe the opportunities will be better. And so we chose to decline a lot of opportunities that presented itself during that time, in hopes that we would see better opportunities and have a higher and better use for the capital. I think now, as we're sort of entering that next phase, it feels like transactions are starting to come back to market, starting to see more new transactions or repriced transactions becoming available. And so we're starting to really dig in and take a look. I don't know, if I had a crystal ball of what would be 6 months from now or 12 months from now, I'd be in much better shape. And we're just trying to do the best with the information we have to figure out when it makes sense to re-enter the market in a meaningful way. We are doing transactions selectively. We're really, as I mentioned, we're moving forward with a project-based Section 8 community. We're moving forward with a mixed income property with a very significant preferred equity structure for ourselves. So generally, the things that are moving forward, we feel are very safe bets. And we're waiting for the opportunities that are sort of the maybe greater value propositions to present themselves. I don't feel like we've seen them yet. And I don't know that they're coming, right? The market could rebound with interest rates where they are, and cap rates hold constant. That's a very real possibility. But we are trying to save some capital for those opportunities should they present themselves.
So with some of the things that's come back to you, have you seen, and you're talking about pricing adjustments, has that been a change in buyer pushing back to the sellers? Is it difference in seller expectations? Is it, where have you seen that buy sell sort of come together at this particular juncture? I mean, have we seen a decrease in pricing? Have we seen that come to bear at this point, or are sellers kind of still holding on to, hey, I was operating this in December, January, that's where we should be looking at, and cap rates are X, and that's what you should be paying me? Or has there been a shift yet?
Well, I think that what you just described is exactly what is happening. Buyers think there's a shift, and sellers think there isn't.
Yeah.
And sellers who don't need to sell are just going to wait. And so I don't know that I can come to you with an example of a transaction that was priced at a 6, or say a 5 cap, and has now been repriced and agreed to at a 6 cap, right? That's not out there right now. I think you have this this tension between buyers and sellers saying, they'll just keep it off the market. And frankly, we as a seller would consider that, right? Now isn't seemingly the opportune time to sell something. So I can certainly understand that position, especially with interest rates likely to stay low.
Right.
It'd be one thing if we thought there was a short window of opportunity to tap into the low interest rate environment. But I think for the most part, the consensus is that interest rates are low. They're likely to stay low for the foreseeable future. So the leverage condition should hold for a little while.
So how has this changed kind of your strategy for the next 12 to 24 months? You've kind of touched on it here and there in terms of acquisition and disposition and how you're viewing this. I mean, it seems like a balance of capital with where the markets are going to go with
Yeah.
it versus, do you really want to be selling out of your portfolio? I mean, it's talk a bit about how has this shifted and how you thought you might be looking at to where you may be positioning yourself now.
Yeah. So first of all, we came into the year hoping to deploy 85 to 100 million of new equity into preservation fund deals specifically. And I think that we've dialed back that expectation. I think if realistically, if we do 60 million, that's probably where we'll end up. And that's the equity portion. So with leverage, the transactions would be a couple $100 million probably. Um, I think that that's just sort of a realistic assessment. Due diligence is harder. Getting agreement between buyer and seller is harder, as we just touched on. Site visits, logistics, all of those things present new challenges that we haven't historically had to deal with.
Mhm.
As it relates to our disposition efforts, because we do own a portfolio at this point that we've built over the last 7 years or so, and those vary in their stage. And we entered this year planning to sell one asset from our portfolio, and actually it sold on April 30th. So we were under agreement, and that was long in the works. So that was one of our successes during COVID, and it was a tax credit resyndication of a deal we bought about 3 or 4 years ago. So same GP on both sides of the transaction, so that allowed it to move as smoothly as could be expected. But otherwise, we didn't have much in our disposition hopper this year. So I think for the most part, we're staying in that position. Although we do have a few transactions in our portfolio that are sort of um, coming to us, and our partners are asking, like, maybe we should put it in the market later in the year. So it's possible we'll sell one or two more. But right now, we've sort of achieved our disposition goal for the year. I think really where what's sort of materialized that we didn't expect was the pipeline of deals in our portfolio we might look to refinance.
Mhm.
We have sort of a variety of debt vehicles in place on our assets, some fixed rate agency, some fixed rate HUD, some variable rate agencies. So we're looking at pretty much refinancing all of our variable rate agency debt into a fixed rate execution, whether it's agency or HUD, depending on the transaction. And then in the case of our properties that are in fixed rate debt products today, we're evaluating very carefully our prepayment penalties and what mobility we have to replace the debt we have in place. Because what once we thought was very attractive debt, in today it's hindsight's 2020. So
Right.
we're reconsidering those things.
So, obviously, this has created all sorts of opportunities for us to become better managers and better business folks, and get more creative in how we have to manage stuff on a go forward basis. So, what are some of the biggest lessons that you've learned for your organization that you think you'll take away, either as just learning experiences and or things that might change the way you operate on a go forward basis coming out of this that maybe you didn't know before?
Yeah, I mean, I think something I always knew, but sort of have a difficult time balancing is the fact that these very hot markets always come to an end, right? Like that is an inevitable in the real estate space. And it seems like we've been on a real surge since we started this business at Enterprise, since 2013, right? We even in 2013 and 2014, we're like, are we at the top of this market cycle? And it just kept climbing.
Right.
Um, and you continue to convince yourself, frankly, to sharpen the pencil, right? Like to compete, you got to have a very sharp pencil. And, you know, that came to an end in a hurry in a way that I don't know we experienced in 2008 or in prior recessions. But certainly this um, dynamic of the market cycle coming to, if nothing else, a pause, but probably an end of this part of the cycle. Um, I think that's just something that is good sort of grounding that we all as real estate professionals need once in a while. That, hey, we can make certain assumptions, but they don't always prove to be true. You can have setbacks. And so I think this will inform our underwriting going forward in a way that is out there, it will happen eventually, but this sort of sets it back. And I think it sort of puts everyone in a position to reevaluate, because one of the challenges you have in these aggressive markets is, well, everyone's sharpening their pencil further and getting more aggressive in their assumptions. And I think everyone's going to take a step back on some of these things, mainly the value add strategies, these rent growth strategies we've seen that just, they're not coming to fruition the way they were underwritten. I'm sure of that. Maybe they will over time, but certainly they've had a pretty big temporary setback. And I think that's going to inform transaction pricing. Separate from that, I think asset management platform, you always know it's important and needs investment and needs attention. But in a crisis like this, it becomes really critical to have the right team in place, which I'm fortunate to have, the right systems in place and platforms to evaluate all the data, and the right partners at the transaction level to get you the data, because we need their cooperation to be able to receive the data we need. And then lastly, just on sort of managing a team of people, this has been a huge challenge for everyone, right? To sort of overnight be sent home, working from home. I think, some of the things we took for granted, sort of realized the value of them, the IT infrastructure that our organization has, the ability to, really overnight put the company at home and work from home efficiently. So those are some of the observations I've had.
Yeah. Terrific. Well, Chris, I appreciate your time. I'd be remiss if I didn't ask you, when this thing gets back to kind of a normalized sort of a state, kind of what are the top 2 or 3 things you're looking to do when you have the opportunity to do so?
Okay, so I'll sort of, maybe I'll characterize them professionally and personally. Professionally, I'll say seeing the team. Yeah, these
Yeah.
Zoom meetings are great, but I haven't seen my team since early March,
Yeah.
and that's hard. I have a new employee who started around then, who I haven't even seen in person yet since her interview. Those are difficult challenges, and I look forward to resuming that. Personally, I'll say I look forward to dropping my 3 kids off at school. That
Yeah.
will be a welcome sight in
Yeah.
hopefully next year. And sure, for both my wife and I, that will be the case. And otherwise, just getting back to all things that we used to do.
Good. Chris, thanks again. Everybody, thanks for joining us. We'll be here on another session with Chris in just a little bit. So again, hope to see you on the first tee somewhere. Thank you.
Thanks, Phil.